For many entrepreneurs, an initial public offering, or IPO, represents the pinnacle of success, a chance to take their company to the next level while unlocking substantial financial rewards. Unlike exits through financial investors, meaning private equity and venture capital funds, or strategic acquisitions, an IPO provides a unique pathway to liquidity, prestige, and long-term growth. However, going public is a complex process that requires careful planning and preparation. Let's explore what investors look for, the benefits and challenges of an IPO, and whether it's the right exit strategy for you. What investors look for in an IPO. Public market investors like individuals and professional investors like mutual funds, pension funds, insurance companies, and similar have different priorities compared to private equity firms or strategic buyers. They are looking for strong growth trajectory. Public investors want companies with a proven track record of revenue growth and a clear roadmap for continued expansion. Profitability, or a clear path to it. While high-growth startups may still be operating at a loss, investors need to see a credible plan for future profitability. Market leadership and competitive advantage. Companies that dominate their niche or have strong barriers to entry are highly attractive. Scalability. Businesses with a model that allows for rapid expansion without proportional cost increases tend to perform well post-IPO. Strong governance and transparency. Public markets demand financial discipline, regulatory compliance, and experienced leadership. Consistent revenue streams. Investors prefer predictable and diversified revenue sources, reducing the risk of volatility. Keep in mind that those who invest in companies via stock markets, they are all individually focused on having small minority stakes, well dispersed within a portfolio, and without a possibility to significantly influence separate companies on their own. That's why they are eyeing less risky opportunities, and if sense that something is wrong, they will sell their shares, potentially affecting the overall valuation. Key benefits of an IPO for entrepreneurs. Going public offers a range of advantages, including significant capital infusion. IPOs raise substantial funds that can fuel further expansion, R&D, acquisitions, and global scaling. Liquidity for founders and early investors. Unlike private sales, IPOs provide a structured exit for founders, employees, and early backers. Keep in mind that when going public, existing owners are restricted on how many shares they can sell within the initial 6 to 12 months after the IPO in order not to disturb market-making process and create sudden stock price volatility. Enhanced brand credibility and visibility. Being a publicly traded company increases trust with customers, partners, and potential hires. Ability to attract and retain talent. Equity-based compensation becomes more attractive to top executives and employees. Mergers and acquisitions. Leverage. A publicly traded stock serves as a valuable currency for acquiring other businesses. Long-term wealth creation. Unlike one-time buyouts, an IPO allows founders to maintain a stake in a potentially appreciating asset. Challenges and weak points of an IPO. Despite its appeal, an IPO comes with significant downsides that entrepreneurs must consider in case there is a valid stock exchange in your proximity where you can list the company. Regulatory and compliance burden. Public companies must adhere to strict financial reporting and disclosure requirements, plus upfront meeting some minimal standards in terms of financials like recorded revenues, place of incorporation, etc. Increased scrutiny and pressure. CEOs and executives are subject to intense scrutiny from analysts, investors, and the media. Short-term market pressures. Unlike private firms, public companies must meet quarterly earnings expectations, sometimes at the expense of long-term strategy. Expensive and time-consuming process. The IPO process can take 12 to 24 months and requires substantial investment in legal, financial, and marketing efforts, dilution of ownership and control, founders often have to give up a significant portion of their equity and decision-making power. Stock price volatility. Market fluctuations can affect a company's valuation, sometimes in ways unrelated to business fundamentals. In short, although it might sound appealing to be listed at some stock exchange, it can be daunting since it shifts the focus from your long-term perspective to managing daily distractions packaged around stock market signals and audiences, meaning public. Is an IPO the right exit strategy for you? Not every business is suited for an IPO. It is best for companies with strong financials, a clear growth strategy, and the ability to handle regulatory complexities. If you seek liquidity but still want control, alternative exits like private equity sales or strategic acquisitions may be better solutions. However, if you aim for long-term scalability, public credibility, and access to larger capital pools, an IPO could be the best path forward. Final thoughts. While IPOs are often seen as the ultimate entrepreneurial milestone, they come with both rewards and risks. Thorough preparation, a strong leadership team, and a well-structured business model are critical to success. Before committing to the public markets, entrepreneurs should weigh the benefits against the demands of running a publicly traded company. Going public is not just an exit, it's the beginning of a new journey.